Are interest rates going up? Now that's a question so many people have been asking this week. There's been a lot of media attention around interest rates and where they're going, and the sentiment has certainly shifted in the sense that it feels like rates are going to go up sooner rather than later. Now today, we're going to talk about why the sentiment has changed and what it means for you. We're going to look at the banks and economists' prediction as to where interest rates are going to go. We're also going to look at what it means for you if you do have a mortgage or you do want to become a homeowner, and how you can prevent interest rates from affecting your lifestyle.
The interest rate forecast has completely changed over the last few months, and now we're at a point where economists are saying interest rates will be jumping from mid-2022. This is a crazy takeaway from early last year, even the middle of last year, Nathan. The Reserve Bank themselves were saying interest rates weren't going to be going up until 2024. Everything's on hold. Interest rates are at 2%, life's great. And then now suddenly we could be hitting a cash rate of 1% by the end of 2022. So what's caused the sudden change?
So there are a number of different metrics that the Reserve Bank looks at when forecasting and understanding where rates might go. We're going to look at 4 key areas that we believe that are important. So the first one is unemployment. Now, this has actually recently increased to 4.2%, which the Reserve Bank didn't actually see unemployment at a rate of 4.25% until the end of 2022, meaning that the labor market is running a full year ahead of the Reserve Bank's forecast. The second is headline inflation. Now, this has recently spiked at 3.5% at the end of 2021. This smashed market expectations, while underlying inflation hit 2.6%. It's now ahead of the Reserve Bank's official forecasts.
And this is the one that most people will be feeling. You would have noticed fuel prices are up by heaps, clothes, electricity, everything seems to be kind of getting more expensive.
And the third is an important global player, which is the US Fed. They're currently shifting direction that will be more supportive of a higher cash rate environment. Now, if the Fed raises its fund rate to mid 2%, it'll actually become easier for the Reserve Bank to do the same. And if global policy settings move to a more restrictive territory, then it'll also open it up for the Reserve Bank to take the cash rate into the 3%. Now, the US Fed recently met and reaffirmed that rates will rise in March. Chairman Powell noted, "I think there's a bit of room to rise interest rates without threatening the labor market." And the fourth is households. Now, household deposits and rising wages may actually lessen the impact of rate hikes. There are a couple of other considerations that will be important determinants of how high rates will eventually go. In particular, household debt and wage growth. Elevated household debt is usually seen as a key constraint to how high interest rates can actually go. But relative to income, overall household credit is only a little bit higher than when it was prior to the global financial crisis. What's more, if household deposits are taken into account, the net household credit to income ratio is actually lower than it was in the mid-2000s. Now, pulling all these together suggests that the market is likely to underprice the eventual peak in the RBA's cash rate. This is a common feature of the tightening cycle that lasted from 2002 up until 2008, with the market continually premature in its expectations that the cash rate had peaked. Something very familiar could play out over the coming tightening cycle.
My read on that is the Reserve Bank's got it wrong in the past, which leads to confusion because the Reserve Bank themselves have said they want to keep the cash rate on hold, but obviously things are changing all the time. Experts are saying one thing, the Reserve Bank saying another. So who's right? Nathan, what are some of the experts there saying at the moment?
So Westpac's actually brought forward their expectation on interest rates rising to August of 2022, when it predicts the Reserve Bank will actually increase the rate from 0.1% to 0.25%. Now, Westpac also believe the Reserve Bank will move a second time in October of this year, increasing the cash rate to 0.5%. Now, this timetable is a little bit later than the market is primed for, which it expects rates to increase in June, but Westpac has brought forward its timing from its previous forecast, which was February of 2023. Westpac forecasts are more aggressive than the RBA's, particularly on underlying inflation, which will be at 2.9% in June, or 3 consecutive quarters on the target band in the year.
Yeah, and they weren't the only ones. Even before this latest inflation data was coming out earlier in the year, a bunch of other banks were saying a similar thing. Anyone from NAB, ANZ were all predicting rate rises sort of the middle of the year. Like it says there, AMP and CBA were predicting November. So I think it's looking pretty certain that rates are going to rise. The amount they're going to go up by is going to depend on lots of different factors, like Nathan covered before, the wages, inflation, etc. But if you are a homeowner, what can you do, Nathan?
So if you've already got a mortgage, there's a couple things you can do. You can look at fixing in your rate to get a bit of stability. Typically, you can fix your loan in from anywhere from 1 to 5 years. If you're not thinking of fixing because you're selling the property in the short term or anything like that, it might be as simple as building up your repayments so that you've got a bit of a buffer. If rates do increase, you can start to rely on that, pull out your redraw and use it for any unexpected circumstances that come up. Now, Jaden, if you don't have a mortgage, what can you be doing if you are looking to get in the market and are concerned about rates increasing?
Yeah, a good thing to do is almost like your mock mortgage, your mortgage on training wheels. If you're renting at the moment, maybe jump on an online calculator. So say, for example, the one on our website here, you can put in, well, I'm going to borrow $500,000 over 30 years at, say, a rough interest rate of 3%. The weekly repayment right now might be about $486 a week. But what if rates go to 4%, for example? Well, it's $550. Say if you're renting right now, you might be paying $300 a week, trying to save that extra $250 a week into a savings account. So you almost make up and you're getting ready and acclimatized to say if interest rates got to 4%, what the repayment's gonna be like that. So at least you're not gonna get shocked. If and when the rates get to that point, you've already been making repayments at $550 a week for ages, you're feeling comfortable, and there's no stress.
I think the Reserve Bank has a real challenging assignment on their hands. On one hand, they've got a lot of pressures, industry experts predicting rates are going to rise. On the other hand, there are a lot of people that are struggling day to day, week to week, and increased interest rates can actually have an effect on the market, could see more properties being sold, and could have an adverse effect on property prices.
I think they've learnt from lessons of the past and they're not going to go hard too quickly. In 2008, they tried that and they put up rates really quickly in a really short period. I myself had a mortgage then, and overnight, the rates were going up by 0.5%. It really slowed down the market and kind of spooked people. So I think they've learned from that, and it's going to be slowly, see what happens, watch it go through. And obviously there's a bit of global uncertainty now with Russia and Ukraine and everything else. So they're going to kind of factor all that into account. I guess to our point earlier, if you've got a current mortgage and you're worried about interest rates, fixed rates totally make sense. You can split your loan even to have sort of a best of both worlds strategy, or get your mortgage broker to review where you're at. See if your rate's competitive, potentially look at refinancing. If you're saving for a home or looking at getting in the market this year or next year, check out that mortgage on training wheels. Work out where you're gonna be, say if the interest rates are at 4%, for example, and make sure you feel comfortable at that level. If not, you might have to look at a cheaper place or try and get a pay rise and try and hustle that way. Because like Nathan said as well, there's a lot of wage growth pressure. So you might be able to upgrade up and get another job somewhere else to get high in pay.
So that's it for today, guys. Leave a comment below on what you think rates will do and if they're going to go up. Here at Hunter Galloway, we get home loans approved. So if you're looking for a mortgage broker and living in Australia, we can help. Call us on 1300 088 065 or visit us online at huntergalloway.com.au, and we'll see you next time.